Hey, good day. I'm Scott Shellady here in the Seymour Group Floors in Chicago. Let's talk about grains, something close to my heart. I actually was out at our family farm this weekend. A lot of guys getting a lot of work done because it was nice weather, nice and dry, so there was a lot of combines in the field kicking up a lot of dust, actually. But other than that, we still have the damage that the USDA caused this market last week. And here's the deal, right? I've been doing this for a long time, and as you get those USDA numbers going from, say, January to December, and you get them monthly, you don't get one in December, but as you get those numbers monthly, as you get closer and closer to the end of the year, you should be getting a better and better feel about where the crop's going to be at. That's why this was so significant. Had it been a surprise in January or February, the market would just kind of shrug the shoulders. But we started to get comfortable and get some expectations of where the market was going to be, and it came across as very, well, extreme. I would say very bearish. We blew out every big number, production, acreage, and the likes. So we now have a situation where we're just trying to get our feet back underneath us and recover from that. So things still weigh heavily. You can't really talk about the grains without talking about tariffs. And although there hasn't been anything new as of late, it still weighs heavily on the market as it does other markets. You know, it's funny that the tariffs don't just affect grains. It affects everything from money to bonds to the like. So we've got an issue where we've got this big elephant in the room and we have to deal with it. We just don't know how. I'll say this. It's not going to last forever. Jack Ma from Yahoo came out yesterday and says he thinks it could be up to 20 years. Well, you know what? Donald Trump, he doesn't have the patience for that, and he won't be in office either. But I think it's something that we're going to get some clarity on sooner than people think, because I don't think that our economy and or the Chinese economy can take a lot of it. So keep that in mind. Can't really talk about it unless we talk about tariffs. And right now, the tariffs are kind of a black cloud on the market. And lastly, we went through some technical levels on the downside yesterday, and it had everybody in a little bit of a kerfuffle. Dees corn traded down to 342. It was off 5 1/4 cents. Not good. That then wants to kind of tell us we might take a peek to 337. But today it's found its feet a little bit. We've bounced a tad. We're up a penny or a penny and a half, trying to find where we're going to be at here. And it looks as though we need to kind of use that level as something to bounce off of in order for us not to trade lower, and I think that could be the case. It looks as though that 342-ish level might hold for a little bit of a short-term bottom here. Keep that in mind, because if we do get back down to 342, your technicians will tell you they want to take a look at 337. So that's the numbers. Got that out of the way. We've talked about tariffs, and we'll see how this market kind of shapes up going into next week, having got that bad USDA report. I'm Scott Shellady here back in Chicago, having a great time. I'll see you again next week from Chicago. Hope you have a good one.